Welcome to the Metals Market Minute, your deep dive into the world of precious, industrial, and strategic metals. I'm your host, and we are wrapping up what can only be described as an astonishing October month, a truly historic one for precious metals. Silver has broken a major decade-plus resistance level, and gold has surged to yet another new all-time high, firmly positioning itself in uncharted territory. Joining me, as always, to break down the key moves, the geopolitical drivers, and the minor news is our editor and market analyst. Welcome to the show.
Thanks for having me. I'm energized just talking about major changes in metal prices. The activity has been breathtaking.
Breathtaking is the right word. Let's start with the silver price. For years, silver was called the frustrating metal. It moved slowly, often lagged gold, and couldn't recapture its previous highs. But in October month, that changed dramatically. It's a story we haven't seen in a while. What's propelling silver toward $49 per ounce and rewriting the metals playbook?
It was a massive month, pushing past a level not touched since 2011. And when you look at the silver price chart, it's not just a surge, it's a violent breakout. To put its momentum into perspective, the gray metal is now up an astounding 72% year to date. That means silver is not only leading the charge, but percentage-wise, it's actually outperforming gold, which is usually the headline grabber.
That is a significant reversal of the gold to silver ratio trend we've tracked for so long. What are the core components fueling this surge, especially when compared to gold?
It's a combination of factors. First, you have the industrial demand story. Silver is a critical component in the green energy transition. Solar panels, electric vehicle battery technology, and various high-tech conductors. The global push for decarbonization provides a structural, long-term demand floor for the metal that gold simply doesn't have. This industrial narrative has been building for years, and now, with global manufacturing picking up, that demand is really hitting the market. Second, silver acts as leverage to the gold price. When gold is surging, silver often follows, but with greater volatility, both up and down. Since gold has been on this steady, months-long, record-setting tear, silver was coiled. Once it finally broke that key psychological and technical level around the $30 mark earlier this year, the upward move has been explosive, driven by short covering and speculative money pouring in to catch up.
So, silver is benefiting from both the industrial green tech boom and the flight to safety trade that's driving gold. It sounds like a perfect storm for the metal.
Exactly. And what's interesting for investors is that despite this incredible year-to-date performance, when you look at the silver's daily price chart as on 27th October 2025, the long-term relative value still suggests it has a lot of room to run if the gold-to-silver ratio reverts to historical norms. The rally is fundamentally sound. Gold's $4,030 summit and the de-dollarization driver.
Let's transition to gold. It certainly hasn't been slacking off. The headlines for gold have been consistent this year. New all-time high. Where did the yellow metal end? And more importantly, what is underpinning this relentless rise?
Gold had another record-setting performance, getting very close to the US $4,030 per ounce mark. This has crossed the absolutely crucial psychological level, slightly down from the peak of $4,379.71 per ounce. It continues to see strong support from a variety of underlying factors: geopolitical tensions, persistent inflation expectations that the Fed is struggling to tame, and massive institutional accumulation. But the biggest news that has really turned heads this month, suggesting a deeper structural driver, came from China.
Tell us more about China's move. This has massive geopolitical and financial implications, beyond just the price of gold.
It absolutely does. People familiar with the matter revealed that China is looking to significantly boost its position in the global gold market by trying to become a custodian of foreign sovereign gold reserves. Essentially, they've been approaching central banks in friendly countries, encouraging them to buy gold and store it in custodian warehouses linked to the international board of the Shanghai Gold Exchange.
So, they are actively encouraging other nations to shift their reserve storage and, implicitly, their trust away from traditional Western financial hubs.
Precisely. Experts see this as a highly strategic, calculated move and yet another massive step in the ongoing multi-year de-dollarization trend. If successful, this repositions China not just as a major consumer of gold, but as a central pillar in the global gold financial architecture. For gold investors, this is massively bullish because it represents structural, multinational demand from central banks, which are the ultimate long-term holders. The more this trend gains traction, the more gold moves from being a speculative asset to a core strategic reserve, insulating it from short-term market noise.
This is the story of the decade for gold, moving from a niche investment to a core tool for sovereign balance sheets looking to diversify away from the US dollar. Moving to monetary policy, which always affects the metals market. We just had a 25 basis point cut in September 2025. What did we hear from the Fed that is guiding the market's expectation?
Federal Reserve Chair Jerome Powell spoke, and he indicated a more cautious approach to future interest rate cuts. This language comes amidst ongoing political pressure to accelerate the cuts. Powell continues to resist that pressure, but the market is clearly betting against him, at least in the short term. The market sentiment, reflected in the CME Group's FedWatch tool, still shows a reduction is highly likely at the Fed's October meeting.
So, the market is pricing in rate cuts driven by economic necessity, potentially foreshadowing a slowdown, even if the Fed is trying to sound hawkish. This is inherently bullish for non-yielding assets like gold.
Exactly. Gold thrives on two things: fear, geopolitical tension, trade wars, and low or negative real interest rates. If the market believes the Fed is trapped, either cutting too slowly and letting inflation run, or cutting too quickly and confirming a recession is near, gold wins on both fronts. The current environment is the sweet spot: persistent inflation, global uncertainty, and a reluctant but inevitable easing cycle.
This brings us to the biggest question on everyone's mind. With gold now trading around $4,059 US per ounce, does its run continue? US 4,000 once sounded distant. Now it's close. But what's the outlook for the next few months?
That is the $1,000,000, or perhaps I should say $4,000 question. The consensus I've been hearing from a variety of experts across different spectrums, technical, fundamental, and macro, is a decisive gold's run is not over. 4,000 US dollars, which sounded like a fairly distant theoretical number just a few quarters ago, is now surpassed comfortably. And the conversation is moving well beyond that. Analysts are projecting prices north of US 4,500 to 5,000 as realistic 2026 targets, fueled by persistent central bank de-dollarization and expectations of broader monetary easing cycles.
That sounds overwhelmingly bullish. But you're an analyst, so you always give us the nuance. Any caution lights flashing? Any caveats investors should be aware of?
Monica, absolutely. The universal caveat, and it bears repeating, is that nothing moves in a straight line, especially after gold's explosive climb in recent months. With spot prices now hovering around $4,060 to $4,100 per ounce, the market is undeniably overextended in the short term. Most analysts agree that a healthy correction is not only possible but likely, as traders lock in profits after gold surged past $3,800 US dollars and $4,000 far sooner than expected. As Steve Barton of In It to Win It aptly put it, he'd be surprised if gold sustains above $4,100 without at least one meaningful shakeout first. For investors, this implies readiness for a 10 to 15% pullback, a move that shouldn't trigger alarm, but rather be seen as a strategic re-entry window for those confident in the long-term fundamentals: central bank de-dollarization, easing monetary policy, and ongoing geopolitical uncertainty that continue to anchor gold's secular uptrend.
Shifting gears away from precious metals to industrial metals and miners, we had some significant company news last month, particularly in the copper space. What's the story with Freeport-McMoRan and its Indonesian operations?
We saw a major, unfortunate negative development there that sent ripples through the copper market. Major miner Freeport-McMoRan declared force majeure at its Indonesia-based Grasberg copper gold mine. This followed a tragic mud flow incident in the underground levels that resulted in employee casualties. The operational impact is massive. Freeport has been forced to cut its sales guidance for the third quarter and now expects deferred production extending through 2026 and even into 2027.
How significant is Grasberg in the global copper market?
It's critical. Prior to the disruption, Grasberg alone accounted for about 3.2% of global copper mine supply this year. The market immediately reacted to this supply shock, pushing copper prices higher. Conversely, the company's share price took a sharp dive on the back of the news, reflecting the long-term production impairment. This incident underscores the fragility of global supply chains and the massive leverage that single, large-scale mining operations have on global commodity prices.
Finally, let's end on a high note with what was a truly explosive stock move last month. What drove the gain in Lithium Americas?
This was the stock story of September 2025 month. Shares of Lithium Americas spiked over 100%. It was a dramatic move that briefly made it one of the hottest stocks on the market. The catalyst was a Reuters report suggesting the Trump administration may be gearing up to take a 10% equity stake in the company.
An equity stake? That's highly unusual for the government, especially for a US-based critical minerals company. Why the government involvement?
It's tied to national strategic interest and the company's Thacker Pass lithium project in Nevada, which is a massive, highly strategic U.S. source of battery-grade lithium. Lithium Americas finalized a $2.26 billion loan from the U.S. Department of Energy last year, but the government had been looking to renegotiate terms due to concerns about lower lithium prices at the time. To secure the long-term funding, Lithium Americas reportedly offered the government no-cost warrants that would equate to that 5 to 10% common share stake. The White House commented that President Trump supports the project but wants it to be fair to taxpayers. It's essentially a government-backed vote of confidence in a critical domestic supply chain, which sent the stock soaring as it provides maximum certainty for the project's long-term financing and political support.
So, whether it's silver benefiting from the green energy transition or the US government backing a major lithium producer, the strategic minerals theme is alive and well, driving incredible volatility and opportunity, a truly eventful month across the board. Thank you for sharing your incredibly detailed insights here on the Metals Market Minute.
Always a pleasure.
And that wraps up our look at the markets. Thank you for tuning in. We'll see you next time for the Metals Market Minute.